The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. If you're enjoying these podcasts, we would appreciate it if you would mash that subscribe button and always make sure you're getting our latest release. And if you know anyone who might appreciate hearing about this, we'd appreciate it if you'd go ahead and forward those links on to them and let them in on the secret here. Let them see what we're doing here. We appreciate that.
So we labeled this one Surprise, Surprise, because that drives the market.
Oh, doesn't it?
The market is anticipatory. It's looking forward to events, preferably calm, steady, reliable events, so that we can, at some level and somewhere on Wall Street, manage the math to estimate what price should be at some date future.
Well, that's always true, right? Not everybody knows what's coming up, right? Everybody knows. Just read. Everybody will tell you, here's what's about to happen. Here's what these next numbers mean. Everything is known and is going to happen in orderly fashion. It's amazing how often nothing even close to that is what actually occurs.
Well, just take the Fed meetings that happen almost every month. They skip a couple months for vacation purposes, but the Wall Street analysts expect the Fed will do X. And Mr. Powell announces X, and next month X, and next month X. And then he does Y. And nobody was looking for Y or Z the following month after that. And where'd that come from? What's going on? What is the Fed going to do? What do we adjust here? Those are all expectations, and most of them have to do with macroeconomic issues. Trying to figure out how the global economy is going to work in advance, responding to somebody's words.
Right.
Well, that could be a pretty big bet.
Yes. Yeah, no kidding.
Especially
it's huge. And it rarely occurs. It's huge, and that's assuming that if the numbers come out even close to what what they were expecting the Fed to say, what's the market going to react? I don't know how many times the markets come out with numbers that are, this should be good news, but the market's diving because all of a sudden, we've decided the good news is bad news or the bad news is good news, and so even if you get the data that comes out that you were expecting, the market reaction isn't always what you thought it was going to be anyway. So it's always a mess. It's always a surprise. And then people are always surprised that there's a surprise. And that should not be a surprise. This is a business. Economics is a business where you never know exactly what's going to happen. And then you never know exactly what the reaction to what happens is going to be either. And that's why this is so much fun.
Well, one of the changes that occurs are correlations. You say, what's correlation? What's math? And finance is math. So what happens when your assumptions that stocks and bonds respond to economic news in opposite direction, which is the premise of most people's portfolios?
Correct.
That you're going to own stocks and you're going to own bonds, because when stocks crater, bonds will rise. So that is negatively correlated. One goes up, the other goes down. That's your plan. And they balance each other out, providing you with emotional safety from really messing things up when the market turns down.
Right.
But what do you do now that the correlations have gone from negative to positive? The market goes up and bonds go up. Market goes down and stocks go down. Or you have a bond market that is absolutely out of whack with long-term assumptions, which it has been for 4 years. Here's with the start of 2025, we see some turn that perhaps this will last, that the bond market actually has some positive return year to date, squeaking it out because some days it's a negative year to date.
Right.
And that's basically isn't part of the assumption of a standard portfolio structure. That's a surprise that lasted more than a few months. It's lasted 4 years. How do you respond to that?
Yeah, that's a really big deal, because if you're a pie chart investor, if you use modern portfolio theory, if you use those standard asset allocation models, the only way those work is if what has historically happened long term happens every year. Truth being that almost never occurs. Those long-term averages almost never pencil out in the present the way they have over the last 50 years. You don't get those numbers, and so it's a constant. You have to constantly try to convince yourself that, well, over longer periods of time it's going to be okay, and all these surprises, they don't really matter, because over the long term it's all going to work out. And nobody's investing over 80 years. You don't have that kind of investment lifetime, and so you never really get those market returns. So those allocations are really meaningless in your portfolio, and it's important to understand that. It's important to note that that nobody gets those market returns, because no one has that kind of time in the market. Nobody's got 70 years to sit around in the market and wait for things to work out. And if you happen to be in one of those stretches where for 20 years things aren't going to work the way you needed them to, that can really put a hole in your retirement.
Well, in that 20-year time frame is a problem that value investors have. Value
Sure. Sure.
investing as a discipline can be out of sync for a couple of decades at a time. Historically,
Yep.
that's the way things have been, and there's no reason to assume that that 20-year period of underperformance won't occur again at some point in time. You
Right.
make me think of a book called The Turtle Traders. Turtle
Sure.
Traders managed to set some real impressive records with a trading discipline really focused on momentum. But along the way of setting phenomenal return records, they had some phenomenal bad trades.
Yep.
And the challenge was, what do I do now? I'm almost out of capital. What's your discipline? Well, go back and follow your discipline. And in the book, as they point out, going back to the basics and staying with the discipline actually reversed the losses, and they continued to set record returns in their portfolio performance. If you haven't read The Turtle Traders, you should. It's an interesting read, even though most of us don't replicate what they did. You learn that you need to be disciplined in whatever you're going to do, because you, like the rest of the market, will have your personal sentiment change from positive to negative to neutral and back again. And
Right.
the and the big surprises that come, for the most part, are relatively short term in the market. They're macro generated. The basic things that should be a surprise, for the most part, were anticipated. One of which just recently is the AI out of China.
Deep seek. Deep seek.
Deep Seek. Thank you. I had
Yeah.
Big Seek on there. Deep Seek.
Close. Yeah.
So Deep Seek just destroyed $1 trillion worth of market cap in a day or two.
Right.
Yet Deep Seek had been around for a year, just nobody paid attention to it. And
Right.
actually, just a couple of months before it became headline here, Forbes had printed 2 articles just a few months before about DeepSeek, what it was doing, and the possible impact it was going to have on the marketplace and AI in general. Well, AI hasn't fully recovered from the shocking news that had been around for a year that nobody paid attention to.
Right.
But it is making some recovery. But there's another surprise. Let's think back to Bitcoin. Bitcoin now is 10 plus years old. It's a decade or so, somewhere in that time frame. Been a lot of additional applications of digital coin along the way.
Sure.
But this last year, we've had a major advance as a result of AI into what is referred to as quantum computing. We have quantum processing chips. And Perry, you were reading the article on the speed of these chips, and I didn't read the article. You recall how fast these things now generate data results?
They're unbelievably fast. They're not silicone based. They compute on photon positions, and they can be running on a single atom or hundreds of them. And the computing speed is the entire focus in quantum computing, and you almost can't calculate it. They are so fast and so much faster than anything that we use now, that they can begin to solve problems that no one even thought to look at, because they require so much computing power. And now those are being brought to bear as they get the error rate down. That's the big problem. Of course, it's very, very fast, but they have significantly higher error rate. And with computing, it's not good enough to say, we're making good time, but we're not sure what direction we're going. That doesn't help. You need to know where you're going to end up, and they're getting that under control now. They're really getting that under control. The error rate's reducing, and the speed is remaining almost unbelievably fast.
Well, the reason I bring that up is because of with Bitcoin and the digital coin, the digital base is supposed to be unhackable. This is where real
Right.
security and privacy are concerned. Well, the CEO of Tether was published in an article. He wrote an opinion piece, got published this last week. And he said, with the development of quantum chips, Bitcoin will be cracked, particularly for people who have lost their keys to Bitcoin account and can't move them, or can't upgrade their software to defend against a quantum breach. What you want to talk about a big surprise. When that happens, what suddenly happens is that the limited quantity of Bitcoin, which is the primary premise for its rapid rise in price of recent years,
Right.
disappears because the quantity increases. And what happens suddenly if there's an extra 10% or 15% of coins available to trade? Now, nobody knows how many people have lost their key to their Bitcoin account because they're
Correct.
not standing up and saying so.
Absolutely.
Look at me.
But
I
they
own
will if all of a
1,000
sudden there's a way.
Bitcoin, but I don't have access to it. I am
I
rich
can't
on
get
paper.
it. And as soon as they can access that again, they're going to. And that's what he was writing about. It's like all of a sudden there's going to be all this Bitcoin that resurfaces. It gets back in the ecosystem of the cryptocurrency. It's going to wildly affect the value. Crypto does a lot of things, but one thing it cannot overcome is supply and demand. And if all of a sudden the supply increases radically, that's going to significantly affect the price. And that's an unknown at this time. How much is going to show up? They don't know, but it's enough that a Bitcoin a Bitcoin base like Tether's is saying, yeah, we probably need to look at this because there's probably a lot of it out there. And there you go. That's something else that's going to be that's going to one day all of a sudden be look like a surprise from nowhere that's been percolating for a while, but nobody's really considered what happens the day that actually occurs. And that day's getting closer.
So is it right around the corner? Well, that's a function of your time frame. Even the CEO of Tether says, yeah, it's probably not this year, but within the next couple of years, Bitcoin's going to get hacked because of this new advance in quantum power. That's a big surprise. And when that happens, it won't just be Bitcoin, it will
Right.
create havoc in the sentiment of investors who will then doubt the security of anything they happen to have. We would expect to see that as a black swan event that craters the market, at least in the short term. And then people will figure out what's real and what isn't, what they still have,
Right.
and it'll all get repriced and work its way back up over time. What do you do about it? Well, you got to pay attention. If you don't pay attention to your accounts and you know what's going on, you're at the mercy of whatever else happens. And there's no crystal ball to tell you that in advance. It's
There is not. That's true.
You need rules, discipline, and process, without which you're at the mercy of the markets. If this is of interest to you, it's probably of interest to friends, family, and coworkers. We'd appreciate it if you would pass along the links for them to listen to and subscribe. If you've missed any of our stock market webinars on the first Saturday of the month, go to our website and register for the next one. The shortcut is iriradio.com. Stay tuned. We'll have another posting in a few days. Have a great day.